Welcome to the Bullish Money YouTube channel. We have a very special video today about silver market manipulation, silver price manipulation. Do me a favor though. This is going to be a video about the technical mechanization behind silver price manipulation. And I would very much like and appreciate if you would share this video, because finally we're going to do something that most other people don't do. Most other channels and experts, they talk about silver market manipulation as if it's already an assumption. And this video is going to be different because we're going to lay down how silver price manipulation actually works from a technical perspective. We're going to use a lot of math to persuade you with the manipulation argument. And so this will be a great video to share with other folks that may not be aware of the shenanigans that occurred not only in the precious metals markets, but also in pretty much every other market. So let's get down to it. Silver market manipulation. Why I got interested in this particular topic was I was reading an article from Business Insider, and it's entitled The 12 Most Infamous Economic Oddball Theories. And they have these 12 theories that they lay out that have been prevalent on the internet. And one in particular is called that there's a massive manipulation within the precious metals market. And of course, everybody that is familiar with this story knows that there's been, for years now, ongoing accusations that the big banks are manipulating the price of gold and silver, and in particular silver, with JP Morgan having naked short positions that artificially suppress the price of silver. And the Business Insider article goes on to state that the Commodity Futures Trading Commission has launched multiple investigations, and they have concluded that there is no evidence of market manipulation within the silver sector. And so really, what is the proof? What is the evidence that the silver market is manipulated? Well, you can't find that answer based on price alone. Price is it's a very tricky mechanism because it is a summary, basically a summary of a day's trading pattern. And so it glosses over a lot of the intricate details. And also because price for one asset is different compared to another asset, the comparative analysis becomes very much distorted. So instead of looking at price, what I like to focus on is volatility. Volatility is a derivative. Volatility is something that can transfer between assets, because we're not measuring the price of the assets. That's a very topical analysis. We're digging a little bit deeper. We're having an apples to apples comparison when we talk about volatility, because volatility, again, is a derivative metric. A derivative metric can be used to compare between disparate assets. And so what I want to do is to juxtapose silver volatility with the volatility found in the S&P 500 benchmark equity index. And we're going to use the trailing 12-month average for volatility so that we can narrow down our numbers, so that we don't have crazy numbers going all over the place. We're going to narrow down the volatility curve, if you will. And so when you juxtapose the S&P 500 volatility and the silver volatility, you see a very similar looking chart. You see basically an S-curve. And one of the things I want to key in on is on the positive end of the volatility curve. So this is looking at the S&P 500 and the silver price when both assets are in bullish cycles, when there's a lot of buyers there, when there's buying momentum. And you can see at the end of the volatility of the bullish volatility curve, the positive volatility curve, that as investors become more bullish towards either the S&P 500 or towards silver, that the trading becomes more frenetic, that there are huge gap ups between the sequence of trading. So you can see that for the S&P 500, you see that there's a big pronounced gap up. And you see in silver, because it's inherently a more wild and volatile investment to begin with, you see a series of big gap up moves in terms of the volatility metric. And so this is not unusual. Again, when you're talking about, since we're talking about the bullish cycle, we're talking about a buyer's frenzy. And when an investment becomes frenetic, when it enters into a bubble territory, you're going to see these kinds of crazy gap up moves. That's just psychology. That's the kind of psychology that you're going to find in every financial market, and you're going to find that through pretty much any industry in life. When human beings become very enthusiastic, when they become over enthusiastic, you see this type of frenetic behavior. Now I want you to focus, though. Now this is where it gets really weird, and this is where we really start to hit into the whole concept of the mechanisms behind the silver price manipulation. Here on the negative end of the volatility curve, we see again two similar line charts. But at the tail end of the volatility curve, we see a pronounced difference. We see that the S&P 500 has a very pronounced delineation. There's a very pronounced gap down in terms of the volatility. The negative volatility decelerates at an alarming pace. It almost just drops off the face of the earth. Okay? Now compare that to silver's volatility. Yes, as the bearish cycle increases in magnitude, so too does the silver volatility accelerate into that negativity. But notice that the silver volatility is very controlled. There are not as many pronounced gap downs as there are in the S&P 500's volatility index. That's extraordinarily strange, because we know that silver inherently, as we just talked about, inherently is more volatile. Why is it that silver is more volatile on the bullish end of the spectrum than it is on the bearish end of the spectrum? You see, this is very weird, because the S&P 500, of course, is the blue chip index. Blue chips, generally speaking, compared to other volatile assets, the blue chips really don't move up or down that much. I mean, they're very, very stable. But as you can see, on the tail end of the negative volatility curve, we see a very pronounced, very fearful trading pattern emerge. It's almost chaotic. And we know mathematically that there is chaos, that there is entropy being built in to the pattern of the S&P 500's volatility index, or the volatility curve, because the correlation coefficient on the bearish end of the volatility curve for both the S&P 500 and silver is around 99%. There's a very high level of correlation, of a direct correlation. But the correlation within this specific range, right when the S&P 500 starts to go into a nosedive, when you compare this specific range of correlation, when we compare the correlation within this very specific range, suddenly the correlation coefficient drops down to 80%. Now, it's still a very high level correlation, of course, because both the S&P 500 and the silver volatility, their volatility is accelerating downwards. So, of course, there's going to be a very strong correlation, but it's very strange that overall, when you compare the bearish total volatility indices for both of these assets, it's 99%. But in this specific range, this very specific range, it suddenly drops down to 80%. That's a very, very huge discrepancy, a discrepancy that should not be ignored. Because when you look at on the bullish end, you'll see that there is euphoria. There's euphoria on that tail end of the volatility, the tail end of the volatility curve. There is euphoria in both the S&P 500 and in silver. In this case, on the bearish end, on the flip side of the coin, you only see fear. You only see fear in the S&P 500. You don't see fear in silver. What you see is a controlled downward momentum. It's controlled. That's the key word here. It's controlled. Fear cannot be controlled. Fear is fear. Any good psychologist will tell you that the fear of losing money is greater than the reward of making money, the joy of making money. Any good psychologist will tell you that. Fear is one of the most powerful emotions that a human being can feel, that any living creature can feel. In fact, we are driven mainly by fear. And so it's very interesting that in the broad indices that is represented by the S&P 500, we see tremendous fear at the tail end of the volatility curve. But we do not see the same fear in silver's volatility curve. Why? I mean, that right there, this chart right here demonstrates silver market manipulation, silver price manipulation. This type of trading pattern simply does not make sense. It simply doesn't make sense based on what we know about the human mind, about how fear affects trading, how fear affects every emotion in a person. This type of behavior simply does not make sense. It simply cannot be explained. Because you can't tell me that silver traders are somehow less emotional than the investors investing in the broad S&P 500 index or the funds associated with that track the S&P 500 index. You can't tell me that. I mean, clearly there is something going on. There is something going on. This is not a normal trading pattern. Because what would be normal, what would be expected, is to see silver dramatically drop down. Again, we talked about this before, that silver is naturally, inherently a much more speculative, much more volatile investment vehicle than pretty much almost any other investment vehicle, say for currency trading, foreign currency trading, okay? I mean, there's a couple of investment vehicles that are more volatile than silver, but silver ranks quite high in terms of wild fluctuations. So it's going to get crazy on the bullish end of that volatility curve, but it should also be crazier on the bearish end of the volatility curve. But we do not see that. When you look at the mathematical data, we see controlled downward momentum, controlled. I mean, you can look at this aesthetically. It is right there, right in front of your eyes. Ladies and gentlemen, This is clear evidence of market manipulation.